All right, stocks are posting double-digit returns year to date, but investors can still find some value in the market. Matt Kaufler is a portfolio manager at Federated Clover Investment Advisors. He says that because of the risk aversion created by the downturn, there is still some room to go in a lot of stocks. Matt, we've had an incredible rally since the bottom in March, but you think not everything's been uncovered so far?
Absolutely. There's still some very good values out there. We've found good values in the consumer staples area, the consumer discretionary area, as well as financials. We still think there's a lot of good value there as well.
What do you think? I mean, 50% rally, you'd think that everything rides the market up. How much further do you think we have to go here? Or is it just an individual basis that you're looking at?
Well, we build our portfolios from the bottom up. And even though the market has had a very big move off the bottom, there are still a lot of stocks out there that we think aren't fully valued. For example, Walgreen is a stock that we like a lot. They've undergone a fundamental shift in their operating strategy. They're actually going to slow their top line in order to grow their bottom line. About 25% of their store base was put into place a couple years ago. It's losing money. So they've slowed down the pace of new store openings, and those older stores are going to start to mature and give you a lot of earnings leverage on the bottom line. We think the market's totally underestimating the earnings power at Walgreens.
I mean, and they get so much of their sales from drug sales, correct?
They absolutely do, and as Sue was mentioning in her report, the shift from branded pharmaceuticals to generic is actually a benefit for the chain drugstore companies. They make more gross profit margin dollars on a generic than they do a branded. So there's a positive mix shift occurring for Walgreens that's also going to be accretive to their earnings as well.
Matt, their CEO recently said on their earnings call, and their profit did top analyst estimates, but they say the challenge is how to balance margin and traffic. That is a key balance here for them.
Oh, absolutely. It's still a very difficult environment for the consumer. Even though the same-store sales today were very encouraging, you're talking about expectations that have come down quite a bit.
Right.
And instead of being down 5, companies might be down 3 or what have you. They're still shrinking. Right. So it's still challenging no matter what form of retailing you're in. So there is that very careful trade-off. But the key at Walgreen is the amount of costs coming out of the system as well. They've got a $1 billion restructuring program going on that they're implementing that you're at the crossover point at now, and you're going to start to see the benefits in 2010 and beyond.
When do we see consumer-oriented companies get gains on the top line? I mean, when is it not just about cost cutting and actually about growth?
Yeah, great question. I would like to think that in 2010 we'll start to see that rising tide come back. But there too, it's difficult to say because the consumer's deleveraging. We've had 6-7 months consecutively of consumer debt being paid down. So if the consumer's paying down debt, they're not consuming. And so therefore, to the extent that allocation continues to persist, I think there's going to be difficulty on the top line, and I would expect firms to continue to rein in expenses and focus on full price sell-through as much as possible. When the consumer starts to loosen up, I'm going to guess sometime in mid-2010 probably.